Kapoor. He's joining us on the phone line from his home in Mumbai, and he looks at macros and tries to connect the dots of macros with what's happening in the market closely. Sahil, thank you very much for your time. You may have also gathered the commentary of Geeta Gopinath, and we have discussed earlier the way the dollar index has been faring lately. Join the dots for us. What exactly lies ahead in terms of recovery, in terms of the indicators you are watching, etc.?
Hi Ajay, how are you? I think there are two things to look at. First is it's quite evident that we'll have a very bad Q1, which is April to June quarter across the world. I don't think there is any news in that. It's also quite possible that the second quarter will be one of slight recovery in many countries, swift recovery in some other countries. But I think we have to look at a contrast which is very important. So if we go back to, let's say, 1st of May or 15th of May, the narrative was that this is going to be a long drawn economic winter in many countries, and nobody really thought that you will see reversal in economic numbers or markets for quite a while. For example, between the first 2 weeks of May, when Europe had a full-blown virus, going across its cities, nobody thought that come mid of June, Germany would have just 6,300 cases, or Italy would have just about 27,000 active cases. I think these are the real changes which have occurred at a very fast pace. Similar changes are available when you look at the economic data, mobility trends. For example, if you look at the retail sales which came out of US yesterday, on a YOY basis, now they are down just 6%. Okay, they were down about 30 earlier. The month-on-month growth rate has been 17% plus. Job losses have, reversed a bit, maybe not too much, but they have reversed quite early. And even if you look at the domestic data, I think you will realize that many indicators which we watch very closely, for example, let's say the toll collection through FASTags. We used to collect about 1,800 crores a day. We are back to about 1,100 crores right now. Cement production is back to about 20 million tons a month. I remember distinctly that this number used to be about 25, 26. So many of these data points I can pinpoint. The bottom line is most of these data points were not expected to improve at such a fast pace. So I think that contrast is now quite evident. Markets were expecting or leading this theory, which I think has gotten proved in many markets, and specifically in Eurozone and US, where recovery has been much faster. And I think part two is why this recovery has been fast. I think the key to that is the big economic stimulus, the fiscal support, plus the monetary infusion, which has happened in the developed markets in many parts of Asia, which has helped economies and businesses to revert at a faster pace. Domestically, I think our fiscal support has been a bit under par, and which is reflective in how slowly we are recovering and probably how underperforming dynamics is visible in Indian markets. So I think if you connect all these dots, it's quite clear. Two things are very clear. First is that the rate of recovery is faster than many people expected. I think a lot of theories about V, L, and W-shaped recoveries, I think in many countries they are now being abandoned. Second thing is quite clear that people know how this ends. So this is a crisis where the end is known, whether it is through a vaccine or completely flattening of curve across the globe. In most earlier recessions or market declines, you generally don't know what the solution is. So if you go back in October 2008, I don't think anybody would have realized how the whole global financial crisis will end. But this time, I think people know why and how this can end. So there is a sense of understanding that FY21 for most parts is probably going to be a washout year, but the recovery will be quite swift. And I think this is what is happening globally. And most likely, I think this will continue. I don't think this will end. most likely this dynamics are going to continue, and probably India will pick this up, and we will probably do better.
Sahil, you're also on the side which believe that the recovery will be faster and healthier, right? But in the middle, the second and the third degree effects of the hit, the sharpness at which the economy has really seen the blow. What about that? How are you factoring that in? The SME section has been badly impacted. Many of them will shut shop. Are you factoring in that adequately, or is that a risk which could play out to your hypothesis going forward?
So I think one thing is very clear. What you pointed out is very important, right? So let's assume that if you were at a baseline of 100 and we went down to 30, and now we are recovering. Some countries are at 60, some at 70, and some are touching 100. So let's say if we go back to 110, we want to know what is the final where we settle. So do we settle below a baseline scenario? I think that is the most important question. Countries which are giving sufficient amount of stimulus will probably settle closer to 100. Countries who are giving lesser stimulus or lesser support to businesses will probably settle at a lower new normal. So I think probably for India right now, that appears to be the case, that we'll settle somewhere closer to a new normal, which will be lower than the earlier growth rates. And the most important thing is that stock markets are different from what economy is doing. Because when you go to the stock market, you look at companies and you look at profits. So profit pools are getting valued at the stock market. But when you go to the economy, a lot of MSMEs are going to see a lot of pain. And there is no doubt about that. I think the social impact will be much larger. But if you think like an investor, I think the impact will be lesser, because the listed universe will probably recover faster because of its size and probably the support it can garner from financial resources. MSME, smaller companies will probably get hit more. So I think from a social standpoint, from a economy standpoint, what you're saying is absolutely right. We have to cook that into prices. Second and third round effect will be important. Could be even more stronger than we anticipate right now. But I think the most important thing to rely on is the hard fact and the data, how it flows in. So I think next 3-4 months, we have to look at data very closely. Last 30 days data, I think, has probably surprised most participants positively. We might get a negative surprise also, which will be second or third round effect. So we have to be more data driven, because I think this is a year where a lot of uncertainty is already playing out. So I think more fact-based analysis will be required to ascertain the extent of a problem that you are talking about.